Hi friends, welcome to your channel. Today we are discussing a crucial accounting concept, types of accounts. Understanding the account's type is essential for identifying which ones to debit and credit in various transactions. Before we dive into the types, it's important to know why this concept matters. If you know the type of account you are dealing with, it becomes much easier to decide whether to debit or credit in a given scenario. Clarity on account types equals easier debit or credit decisions. The first account type is personal account, which relates to individuals, firms, or companies. The rule here is debit the receiver, credit the giver. For example, suppose you are selling goods to an individual on credit. So, the individual is receiving the goods. So, that person needs to be debited. Next, we have the real account, which is tied to assets, properties, or possessions. The rule here is debit what comes in, credit what goes out. Continuing our previous example, suppose you have sold the goods for cash. Cash, being a real account, is coming in. The rule here is debit what comes in. So cash account needs to be debited. Lastly, we have the nominal account. This account deals with incomes, expenses, gains and losses. The rule for nominal account is debit all expenses and losses, credit all incomes and gains. So, continuing our earlier example, which is selling the goods for cash, we have identified that cash account needs to be debited. But through the fundamental rule of accounting, we know for a debit there should always be a credit. So, you are selling the goods. So, the sales account needs to be credited. Why? Because sales is an income. It falls under the category of nominal account, and the rule of nominal account says credit incomes and gains. So, the journal entry becomes cash account debit to sales account. Now, let's understand through a different example. Suppose the business is paying salary to its employees. So identify what are the two accounts which will be affected. Yes, it's the salary account and the cash account. Now salary, being a nominal account, needs to be debited because the rule says debit expenses and losses. So salary account debit. Now what needs to be credited? Yes, right. It's the cash because credit what goes out. Cash is going out of the business. So the journal entry becomes salary account debit to cash account. Let's see at some of the common mistakes which we need to avoid. A very common mistake is mixing up personal and real accounts, especially when dealing with debtors and creditors. Make sure to clearly identify the account type before recording any transaction. Now, comment below to whether debtors are real account or personal account. In summary, there are three main types of accounts: personal, real, and nominal. Understanding these accounts helps you correctly apply debits and credits in various financial transactions. Remember, categorizing accounts clearly ensures that your books stay balanced and your financial records are accurate. To recap, personal accounts involve people and businesses. The rule is debit the receiver, credit the giver. Real accounts deals with assets and you debit what comes in and credit what goes out. Lastly, nominal accounts relate to incomes and expenses. debiting all expenses and losses, and crediting all incomes and gains. Please like the video and subscribe to my channel for more such content. Thank you.